Hello, Nick. You're on mute. You're on
There you go.
mute.
Yes.
Hi.
Hi.
Yeah. Hi. Last minute they changed the link. So they just sent me the link. So
Okay. Hopefully everyone
mhm.
gets it and can
Yeah.
join. I'm just pulling up all the prezos.
Let me
Oh,
just check the other link if there are, because I'm not sure. Let me just check the other Zoom room, the old one. I will leave and I will just check the other room.
sure.
Okay, I'll make you the host and
Sounds
I
good.
will. Hello. Yeah, the other link is closed already.
Wonder why they changed it last minute.
Yes. Hi, Steven. Oh, you're on mute.
There we go.
Yeah.
The last
They
minute.
changed the link. Yeah, last
Yeah,
minute.
last minute. Yeah, they just try to, I guess, uniformly just have one Zoom link for
Mm.
all of the deal room calls going forward, right? Versus each one having its own separate. So, yeah. So, Nick, we have, I think we will probably, get you engaged on the SureStay Suites opportunity.
Mhm.
And I think, you and Nick will probably run tandem on that project. So why don't we pull that one up? We'll start that as a basis of today's call. Is we're going to talk about how we, get into an opportunity, I guess fully bake the underwriting, shore up, any loose ends. And this would be also a good opportunity for us to record this for education purposes, but this is going to be the SureStay Suites.
Oh,
Did you want,
Space.
or do you want to do this America's Best in Columbus, Ohio? Why don't we do that? We could, since you have it up, why don't we stay with this and then we'll do the SureStay Suites and talk about that as well, because
do you have the presentation, Christina?
No, because this is the one that I prepared as requested by Manpreet. Oh, they're joining.
So see, we might have to do it for next week for the SureStay.
Yeah, we can talk about that on our team call.
Okay.
But yeah, we can run tandem. I'll get involved with it and start giving some lift.
All right, so let's jump into the America's Best Value Inn in Sinclair, in Columbus, Ohio, on Sinclair Road. So this is, I believe this deal was brought to the group last week. Christina, who's the originator?
Manpreet.
Manpreet. Okay, fantastic. Is Manpreet? I guess I don't think he's on the call, although there's been a last minute link or Zoom link change. I wonder if everyone has been aware of that, but we can jump into this. And of course, the call is recorded, so we'll pass this recording out to those who are unable to join for today. But this hotel was built in 83, 136 keys, exterior corridor hotel on 2.78 land acres. And here is a kind of a summary of the asset in question. Seems like it has a good visual appeal from the pictures. Looking at the parking, looks like the parking might be a little short at 122, if I'm reading that correctly. And maybe we can do a larger font or zoom this in a little bit, Christina, so I can see this a little clearer. I think it's the text is going to be, if it's small for me, it's going to be small for everyone else on the call. So in the future, we can maybe zoom in and get a little closer view. But yeah, so that, that would be my initial concern, is the parking limitation there. I know that's going to come up somewhere along the conversation. Do we collapse and condense, or is there room to add surface parking spaces? That's yet to be seen. We'll have to do a deeper dive and see some adjoining parcels and see if we can leverage some parking there. But going on to the next page. So looking at the market and the area in general, I'm looking at an absorption of 259 units. So certainly some positive growth there. Population growth being in the, I think, low threshold, in my opinion. Anything north of 5% population growth is something that I think you want to kind of pay attention to. Under 5%, you may want to jump into the market a little deeper and figure out, is there some upcoming economic growth that we just haven't accounted for that could prove to make this a winning conversion. Again, what I mean by that is you really want to look for, because this is a relatively heavy lift, markets where there's going to be some big population growth, some emerging opportunity there, and that emerging market will accelerate your returns above and beyond your traditional underwriting. So if you pan to the left, you can see, inventory of units, how many units are in the market. You can also see how many buildings, right? You can see how many delivery of units are coming to the market. So you can kind of, anticipate some competition there, obviously. This being Columbus, Ohio, is a certainly stronger market. And then, of course, vacancy is 6.7. The studio rents are kind of on the lower side, but it all comes down to acquisition price per key. So let's jump over to that.
Stephen, I have a question for the group. What
Sure.
are good ranges for vacancy, right? Like, what would you consider, hey, this is amazing, this is good, and this would be fair to bad?
Well, I mean, obviously a vacancy rate of like negative or zero in some cases. When I say negative, we've done some market research in some markets where there's actually waiting lists at certain competitor properties that we'd be interested in comping, and aligning ourselves with. In fact, so much so that what we were looking at on the Jacksonville portfolio, we actually were initially underwriting that at $950 for the studios. Well, we're just realizing now a rent bump, and we haven't even started. Well, we have started construction. We've just started construction, but we're realizing a rent bump of $1,250. So quite considerably a big market bump, and we're not even haven't delivered the units to the market yet. So that is just an example of an emerging market, what that can do to your numbers, right? So you always want to underwrite conservatively, not necessarily try to kill the deal, but put pressure on the deal to see if it is worth pursuing. And of course, if it still has legs after you put that pressure on, then this is something that you want to look into a little further, invest your time. But back to your question, as far as vacancy, lower the better. Obviously, if the vacancy is high, that's going to bring some questions to your investors, and that's ultimately what you're really looking at these deals from their perspective, right? You want to look at these deals as if you were the investor, you had 100,000, you wanted to go in on a deal as an LP. Is this something worth pursuing? So vacancy's got to be low, really low. Anything over 10, would raise concern.
Appreciate the detail.
So if we go back one more, Christine, it's that previous slide. One thing I didn't really touch upon was the exit price per unit. So you have the market sales price at 105, you have the asking at 71.3. So that brings some concerns as well. I mean, so typically you want to get the asset at around 30 cents on the dollar to your exit price. So therefore, in order for a deal to work, as far as these numbers, you want your purchase price to be ideally sub 20,000 per key at this point. Moving on, any questions on just come again, more back of the napkin underwriting? And I think the more you get a chance to look at conversions, that's something that will help you understand if you want to dig deeper or pass, is by looking at those 4 columns we first looked at. And then, of course, this is an overview of the market itself. Not a lot of detail here, but Columbus being a little bit flat, we're not going to see too much detail. The location is ideal. The market, this particular Columbus market is holding steady, and I know there's a lot of investors that like to invest in this market. So those are all positives. Moving on. Here's some pictures of the asset. So I'm seeing this was brought to us, so I'm not sure if it's under operation, but I'm beginning to think that it's not under operation. It's currently vacant based upon these pictures. There's some roof damage I can see on the top left, but nothing that can't be repaired or replaced. So moving on. Here are our market rents. So studios in and around the what I would like to call studio efficiency studio apartments, or junior studios, which is around 300 square feet. They're renting for about $2 a square foot, so to as much as $2.95. So a little weak on the rents. Moving on. And okay, so back to what I was just talking about, all the information I was just looking at led me to believe that this deal would probably not pencil, and here we are. So we can see the returns are not necessarily in what I like to call the green range, which basically is going to be an internal rate of return north of 30%. And I like to see equity multiplier of being north of 2.5x. And then, of course, I want to have all my capital back inside of 2 years. In this case, it's only 8.6%. And then looking at the cap rate, this is, these are returns on a very low per asking price of 2.95. Christina, do we know what the original whisper price is, or broker price? Was this on the market? Do you know if
Yes, this is the asking price, 2.95, and yes, this is the underwriting works. Underwriting starts to pencil at 1.25.
Okay, so
on the neck,
if Manpreet wants to pursue this or would like us to work together on this, let him know that we could work with him on submitting an LOI at that purchase price of 1.25. I think would be worth pursuing. So you may want to reach out to him and maybe set up a meeting and see if he would like some help. But our guidance price, as far as an offer would go, it would be the 1.25. Does everyone see why? Look at how the returns change once you lower the price per door or per key, and to kind of compensate for the heavy lift. So in order for us to feel comfortable pursuing, that's the range we'd have to be in as far as the purchase price.
Yeah, thanks, Stephen. I'm on the call. Sorry, I had issues joining the call in for the initial 3-4 minutes. But yeah, I caught up on the underwriting where you were going through the CoStar report of the market. So yeah, I'll reach out to the broker and I'll tell him that this is where the price makes sense for us from a conversion perspective. So I'll see what he has
Fantastic.
to
Yeah,
offer.
let me know if you need any help on that, and I appreciate you bringing the opportunity to the forefront so we can learn from it and review it.
Yep.
All right. Christina, do we have another hotel to review?
No more.
Okay. Do you want to pull up the SureStay Suites in Sacramento? Since looking at the time, we have another 15 for the hospitality piece. Let's go to the SureStay Suites in Sacramento, and let's pull up the underwriting.
The underwriting. Okay. Give me-
Yep, and we want to look at that, and I think maybe also pull up the property summary so we can get the participants on the call up to speed on what we're looking at, so we can start there. And then also, I think that would be good for now, just the underwriting and the property
Underwriting
summary.
and the property summary.
Yep. And then maybe also third but not last is the counter.
Analytics.
No, the
The
counter
counter.
on the LOI, so we can show everyone on the call how we got to this point. You know, we're looking at an asset as she's pulling this up in Sacramento, California. They wanted close to 14-15 million. It's 152 keys adjacent to a relatively nice residential community. Ironically enough, this is in our backyard. So we were able to do a site visit, walk the property in question, and it seems to be prime for hospitality to multifamily conversion. The zoning, which is music to my ears, is multifamily by right. So it's supported to be converted to multifamily. So we're going to have a call with the city just to kind of understand the actual change of use aspect, but it sounds like we're going to be able to move forward in that regard. The current owner bought this back in 2018 for 5.3, apparently put in around 4 million in renovations, which we confirmed. So they've updated all the floors, updated all the P-tax, all the doors. They updated the bathrooms, and it looks like, correct me if I'm not mistaken, Nick, did it have sprinklers throughout in all the rooms, or is it just in the
No
common area?
sprinklers in the rooms. They just did a good job giving a facelift to the floors, particularly the bathrooms, tubs, everything, countertops, sinks, fixtures, new locks.
Yeah, so 152 keys. There's enough parking with 175 spaces. It's in a great area, really close to light rail. Sacramento, it being the #1 city, just rated by Forbes magazine in the state of California. A lot of the population growth that we're experiencing here locally is due to the Bay Area, and a lot of people kind of leaving and moving to Sacramento. So really confident as far as getting this, apartment complex filled up. So that's the high level. Let's look at the underwriting. Actually, let's look at the LOI first, and then we'll go to the underwriting. Do you have the LOI?
Yes,
So we
I have.
share that on the call. Super. So this is not the latest LOI. This is our first
No,
LOI. Well, I was asking for the counter back from the broker.
I do not. I think Dan has the copy.
Okay.
Yeah.
Okay, well, I can walk everyone through the call. The latest counter from the seller is what I was hoping to share, but Dan's not on this call because he's in jury duty. But the seller wanted 14, we went in at 12. They countered back at 12.95. So let's look at the underwriting. It would be an Excel doc.
Christine, I think you have it over to the left here on the side
Here.
of the screen. There you go.
Look at it. Can you open that up a little bit? There you go. So we know the seller counted back at 12.95. So let's change the purchase price. And let's go up to the top and look at the top right of the screen and see the exit price per unit. Top right, scroll up. No, I didn't change. I didn't tell you to change the summary. Scroll to the top right. There you go. So the exit price per unit is 230,000 per door at a 4.2 cap rate. So let's go over to the bottom of the screen and look at the all-in cost per door. And we're all in at 153,000. So I'm thinking we may want to, rather than buy and hold, I'm thinking that we should buy and flip. So let's go to the summary. Let's look at the buy and hold first and go to the summary tab and look at the returns. The returns are not bad. This is at 12.95. So I'm thinking about countering back at 12.5 and seeing if I can shave off about $450,000, which I think I can do. But the returns are, better than most, especially on traditional multifamily. I'd like to be all in the green. So let's go to the input tab really quick and let's just look at the rents. Scroll up to the rents. And yeah, so we're looking at after converted, we're renting them for 1165, 300 square feet. I should be able to get that all day long. So yeah, so this is something that we're looking at, probably pursuing. It's a good opportunity. Let's go to the top of the page and take out the refi. So go to the refinancing data in column K, line 16, where it says 18, change that to 0. And then the sale date, let's put the sale date out, say 30 months. There we are. So this is just a straight flip. Let's go to the summary tab. And that's where I think we're going to go. Got a 30% IRR with a 2.25 multiplier. Yeah, all day long, this would be a great project. So those are some of the things that we're working on behind the scenes. Just wanted to share with the individuals on this call and open it up to any questions you guys may have. All right. No questions?
I have one for the group. I think it's worth noting is when we first looked at this asset, the analytics did not show a good absorption rate, but upon our due diligence investigating the area, we realized that there was positive growth. Do you want to walk the group through how we had to look closer at the opportunity to understand the demand in the area?
Yeah, so there are several apartment complexes in the area, but what's unique about this is because this hotel kind of sits in a residential community, it's not going to show the traditional absorption of multifamily units that you would see in a highly, densely populated market, with that being the asset class in question. So what we had to do is we had to look at some markets around this particular asset to see, okay, in general, what's Sacramento doing as far as growth goes, and where are we seeing that growth in this region? And we also were able to look at a few complexes that were just recently constructed in the area, and we know that there's waiting lists there. So certainly really kind of shored up that initial assumption, one that you can certainly bank on when you're, local to the market. Obviously Nick and I both live in the Sacramento region, so we know what we were assuming, but it's something that's important to back up that information with hard data. So that's the first half of our call. I think, if there's no other questions, we'll leave that here. I think we're going to pursue the Sacramento opportunity and present it as such, possibly a buy and flip versus buy and hold. But I do like the returns on the buy and flip, the buy and hold aspect as well, especially if we're able to leverage affordable housing and get some type of Section 8 scenario there, especially being so close to the light rail and its location. So there's some things that we will certainly further explore, but I find it being a very exciting opportunity. All right.
It's my opportunity to jump in here and talk a little bit about self-storage today. Just pulling up the deck right now. So the first one I want to share with you guys today is 5141 Douglas Avenue. Get this in a presenter mode here. So this property is unique because it's been on the market for just over 1,000 days. So we're talking over 3 years of time sitting vacant. And it's something that I had looked at on Craigslist for a long time and was unsure about just due to the population density. But upon further discovery, found it to be a really good opportunity. As you can see on these calls consistently, we've talked about big former Kmart boxes just being an ideal footprint. Doesn't necessarily have to be a Kmart, but they're, with them going under, presented a lot of different opportunities to repurpose these assets. This is from a pitch deck that I actually use with our business partners that are the operators for our self-storage conversions. And you can see all the summary of the data that's going to be applicable to making a decision on this asset itself. And the reason why I want to share this with you guys today is to talk through with you what reaching out to the city, both the Economic Development Council as well as city planning, and the conversations we've had, because this asset has presented a unique challenge where it's not zoned by right, which you'll often see with these retail to self-storage conversions, and how Steve and I have been able to gain favor or get approvals from cities that a lot of other self-storage companies have gone in and not been able to do because of their approach. So we'll dive into that today. Like I mentioned before, just over 1,000 days on the market here. From a state almanac perspective, 6.6 is going to be the average throughout the state. So we're seeing a good undersaturation at 4.7 and 6.4 on the 3 and 5 mile radius. So this is great. So we're going to be able to see, like, if we convert this asset, is there enough demand with the additional 100,000 square feet that would apply? Modest rates at 137 as well as population size. But most importantly, we're seeing an asking price of $4 million. And for this opportunity, we're seeing about $3 million with a 23% IRR. There's some room to wiggle with that. We had looked at vehicle storage. Unfortunately, that's going to be probably a much harder press than a fully enclosed Class A climate control facility like we plan to do with the existing structure. But through talks to the city, we're able to find additional opportunities to work with this asset. To give you guys an overview of the property, it sits in a town center in Racine, Wisconsin. This is kind of a local hub where you have fast casual dining, several different retailers. We'll get a better view of it right here. And this is, a major hub with one of the busiest streets in this area. It's a smaller town, which made it challenging when working with the municipality, but they want to see a lot of retail going here. The first thing that we can identify that is at 17,000 on the traffic count, there's no major or national retailer that would be interested in this box of this size. So the next step the city went through is like, okay, can we subdivide this building into smaller units and then sell those off to smaller retailers, more regional, local ones? But because of the length and width of the building, it would not make sense to subdivide it because you have long, skinny units that wouldn't be applicable to any kind of restaurant, retailer, or what have you. I think Stephen had a good joke that we could turn it into an archery range if we were to do that. But as we went through discussions with the city, we had a couple different opportunities with them where they would be comfortable with the self-storage conversion of the Kmart. The first thing they asked was building a road through our property here that you can see outlined in yellow, all the way to the other side of this park to allow for transit, particularly for police, fire, some of the city services. And at over $2,000 a linear foot, that would be millions of dollars of additional CapEx without any additional revenue to offset it. So that was a quick no on our part. The one thing I did ask of the city, Peter was the city planner that we spoke with, was, okay, what kind of incentives or opportunities can you do to assist with this project? And at this time, they don't have any, but upon discovery, talking with the Economic Development Council, they would start a tax disbursement initiative to help out with this project. And that was something we actually discussed for an alternative use that we looked at this. So taking a look at expansion of the road, not meeting our CapEx or preventing it from penciling, the next question they want to see is, can you add additional retail into this? Well, this parking lot is just over 12 acres and has plenty of room for not only the self-storage business, but additional retail sites. Our first plan was to carve out a portion of this and build out an existing or a new building with anywhere from 20 to 30,000 square feet of vacancy that could be divided up and allocated based on the tenant's needs, which is a big undertaking, of course, and requires looking at the retail rates within the market, leveraging local brokers to discuss what kind of tenants they could find to put in this area, as well as factoring the CapEx for putting a new slab down, building up the units itself, and then working to stabilize that as we go through the conversion of the self-storage. And this started getting the city's attention. Where we ultimately landed was a much easier, more feasible method, which would be platting the parking lots here and developing 3 pad sites that could be sold off separately and parceled to new owners, where they could then take it upon themselves to develop the lands, thus meeting the city's desire for more retail and fast casual dining in the area, as well as giving us the best opportunity to convert this into self-storage and limit the amount of risk or involvement we'd have on the retail side. While we have experience with this and we do projects with mixed use, we try to stay in our lane of self-storage as much as possible, because anytime you add that, there's more complexity. With complexity comes risk. And with both of those, it becomes more difficult to raise capital or work with investors to feel confident about the outcome of this. I'll pause there before I continue on to discuss this property and see if the group has any questions, want more insights into these conversations. Okay. Just another
I have a
global.
quick question for you. I'm sorry.
Yeah, jump in, Travis.
All right. So when you were talking about the additional plat for extra retail, that would just go through zoning, and you would divide that off, and you wouldn't care about losing any sort of frontage. You would just need access lane in front of your building outside of maybe the main door entrance. Other than that, they're not going to attach to your building. They're just going to be additional lots. Is that right? So it wouldn't really matter how close they are to your building, because frontage isn't a problem.
Correct. Now, the city planning, when submitting site plans, will look for like ingress, egress of traffic, where fire hydrants are, certain like safety measures that meet the city ordinances. But we don't care if they're right outside of it, even obscuring the building itself, because there's plenty of room there. So you're correct in your thinking on that.
Thanks.
Yeah, my pleasure. Anyone else have questions on this, or how to even approach city planning, or what kind of methods, how to look that up or contact this?
Did you guys take it as far on those pads on the estimated value for that? Or would that come later?
No, that's actually something we sought out to find. So my market research, there was no available pad sites within Racine, Wisconsin, so you can get direct comps. That's where I'm trying to identify, maybe in a greater area, regional area, what we can expect. And then absence of that, reaching out to local brokers that deal with that kind of real estate is going to be the best avenue to get their insights. And then our goal would be to sell it off at maybe 95% of market value in order to move it faster. There's a holding cost associated with it. So the faster we can unload those pad sites, the more we can get a return on capital and do better overall with the project's returns.
Interesting. Thank you.
course. We'll give some more time in case there's other questions. I like when you guys get engaged. To kind of summarize the approach that we've taken with cities is usually the Economic Development Council, or EDC, you'll hear us refer to, is a really good place to start because they have a direct initiative or benefit from seeing increased commerce in the city. They're going to be a proponent of changing it, getting this building back on the tax roll, and really helping to just revitalize the city versus city planning, who's going to be more in charge of deciding what they should do with it. So my recommendation when you guys are looking at properties, besides taking a look at the demographics of population, rental rates, demand, is also reaching out to that EDC and city planning to understand the zoning of it. So we might have an amazing opportunity. Rates are great. The cost of the asset is low, but absent of that rezoning, it does not matter how good the deal is because it's not going to fly. So a part of your due diligence is reaching out, identifying that. Starting with the EDC allows you to get someone that's local, that has knowledge of it, and can actually submit a recommendation for your project before moving on to city planning. We've also, in this case, working with Laura is her name at Racine, Wisconsin, and she's given us insights to city planning, things that they would be looking for in terms of retail sites, hangups that they might have, just anecdotal information that you're not going to collect unless you know them personally. And that allows us to go into these presentations much more prepared and ready to speak to our intentions or our vision for the property, and thus gain more trust and success with city planning. Again, just looking at Racine, Wisconsin here, we can see it's a major corridor here, one of their busier streets, but it is a quieter town, just surrounded with residential areas, making it ideal for this self-storage play. And you can see here, this is straight off of Radius Plus, just a breakdown of competitors with one new build in the area here. But again, back to that original slide that I started on, there's plenty of demand, well below that 6.68 square foot per capita. And these red dots here are going to be our comps or comparables when identifying what's the taxes that we need to factor into the underwriting. And as this project progresses, the next step is reaching out to each one of these in the vicinity, doing a cold call, inquiring about rates, promos, vacancy. You'd be surprised how much information you can get just reaching out to the adjacent competitors and understanding like, okay, wow, you guys are fully leased up, or you're only offering 5x5s or 5x10s right now. Your 10x10s and 10x20s have a wait list. All this information is going to be very important as you move forward to identifying the true demand and not just relying on one report. Here we can see a look at the rental rates as well. Climate control on the right, all units on the left. So this will be an average of both. And just tracking it over time, we can see back in November of 2021, pretty high demand, great rates, and we can see it dropping off just recently. With the move-in of a new competitor, you're going to see stuff like that where as demand shrinks, prices will commoditize, and then each of the competitors will start to lower the rates to attract more and more members, offering things like first month free, different promos like that. When you see these blank spaces here, you can see there's no 5x15s offered. That could mean that there's not a demand in the market, or this could also represent an opportunity to build out that in your facility to attract new people, perhaps looking for that size of a unit. And we can see the same thing here on the 10x20. Just in the last several months, there's a representation in the market, although this means quite a low rate for that unit itself. Any questions on the rates, guys, or getting a look at this? Because this is probably one of the most important things when determining the success of a deal.
Do you see
How do
five?
you-
Oh, go ahead, sir.
How do you find out? I mean, is there a basic formula that you can use that if you have X amount of square footage in a property, that you can get X number of units in there? Something you're using with dead space for hallways?
Yes. So I'll actually jump out of here and share something with you guys. And I'm happy if you want to email me to share it with everyone on the call today too. This is just an Excel sheet. It's not glamorous or anything, but it's my unit mix calculator. So can everyone see that on the screen?
Yep.
Yep. Thank you. I can't see you guys. So if I ask for feedback like that, give me come off of mute. But I built this out here, so I'll enter the total property address, and then I've entered formulas here to factor out 20% for hallways, common areas, office space for it, and then I'll get the rentable square feet here. On the right-hand side, I have 4 different unit mixes. Typically, we avoid 5x5 because of the high turnover associated with those units, although they will have the highest dollar per square foot for rental rates. So you get a really good premium, but frequent turnover of tenants could lead to higher vacancy rates. So it's kind of a gamble. If a deal is pretty close to penciling or we need to get some extra revenue, and I see that there is a bunch of representations in the market of it, I'll go ahead and include a small percentage, maybe like 7%, and back it out of some of the other unit mixes. For the total unit count, you can see the equation right here. And basically what I've done is I've taken the square foot per unit times the percentage, added that up and dividing it by the total square footage available for rental. And that'll pop out the total number of units of 658 right here and give me an individual unit count on the right-hand side. From here, I'll take this and plug into the underwriting document for each appropriate size, and then go to the rates that was displayed on the PowerPoint earlier. And that'll give us the initial underwriting for the cash flow minus the operating expenses, which will lead us to the NOI and tell us, what the initial valuation of this property would be. Down below, I have one for RV and boat storage. So essentially what I'll do is I will take the lot size minus the total square footage of the building, and then come up with a total number of units that'd be applicable for just 3 standard sizes. These are larger RV and boat rental sites. And then factor that in as well, if that's applicable to that property, if we're doing outdoor vehicle storage. And then I have one last one right here for drive-up units. Let's say we take a property that's maybe 40,000 square feet of an existing asset, and we want to get it up to, let's say 60, maybe 70,000 square feet of rentable self-storage. We can add in an additional 30, maybe 40,000 on that lot, depending on the size of it. And I have the same unit mixes up here based on the remaining area of that parking lot. And then from there, you can just plug and play. Questions on
That's
the unit?
excellent.
Thank you. Christina, if you want to pop my email into the chat, I encourage any of you guys, if you want to
Okay.
reach out, I will forward on this document as well as any other kind of tools that I've created or things that are applicable. It just makes it easy to calculate all this out and then figure out where I want to go. And the cool part is you can adjust the unit mix. These percentages were supplied to us by our operator sponsor S3 as to kind of like what their preliminary breakdown would be when they've done actual formal engineering plans, business development plans. So I try to stay very aligned with that because this is based on market data, usage rates. One thing I will say though is you can manipulate it by increasing maybe the 5x10s and 10x10s in the percentage wise to create more dollars per square foot. Just like with multifamily, when we see studios will have a premium versus a 1-bedroom, 2-bedroom, or 3-bedroom, same thing with self-storage. You might have your 10x20s renting at $1.25 a square foot, where a 5x5 could be north of $2 a square foot. But again, you're risking turnover and vacancy. Any other questions on this one? So we're going to jump into a new property right here. So this one got me really excited. This isn't all too far from Sacramento either. I think we enjoy having something close that we can drive by and point at and look at something we own. This is Antioch, California. It's a suburb of the Bay Area. You can see off on the left here, median household income sitting at about $92,000 per year, which is going to be on the high side. A lot of the areas that we're scouting could be in the 50s, the 60s, which isn't necessarily bad. Anything between 60 and 80 is going to be a pretty good sign. Once you approach 90 and above, it's definitely a affluent area. And what that's going to correlate to is higher rates for the rentals, and then also any kind of vehicle storage that'd be allowed. This property I want to present to you guys today because it has a robust amount of opportunity, both for the indoor self-storage as well as the vehicle storage. Again, you can see it's been on the market 897 days. That gets me excited because that means you're going to probably have a seller that is a little bit more open to negotiation and looking to move that asset. It's also can be discouraging because there's been a lot of people that have taken a look at that. I can't tell you how many times I reach out to a broker like, we've had CubeSmart, U-Haul, Public Space, all reach out. They've all looked at this and we'll still take our shot. Oftentimes, these companies will reach out to city planning or look at it and say, hey, we just want to do X. We only want to do self-storage. We have to do outdoor vehicle storage or even vehicle rentals. And the city's like, nope. And they're just going to walk. Where we'll come in and have a more collaborative approach with the city to ask what their vision is and how can we marry that to ours to make our business successful, as well as our investors, and most importantly, the city. And by doing so, we're able to come in with some of these assets that have been on the market for 3+ years. And it's because we're taking a different approach to it. First thing I'll point out on this property is the square foot per capita over 8 is definitely concerning. Indicates a saturation, but taking a look at the population growth at 5% and 6% respectively tells me that it's a rapidly growing area and that saturation is going to decrease over time. So while it might be saturated now, there's going to be a lot of growth in the area driven by the migration from the Bay that'll allow us to lease up these units, especially when someone's relocating from one place to another, if they're downsizing their home, if they need to store some of their furniture that they're not using because it no longer fits the aesthetic of their new home. It's going to indicate the opportunity for those self-storage units to be utilized. Great population size in the 3 and 5 mile radius. And then you can see down here, I have it penciled out with vehicle storage and without. So that additional cash flow will allow us to get either a higher IRR or an additional $1 million of spend to meet the property's costs. We'll jump into the purchase or the listed price of this property in just a little bit. You can see that it's up for $12 million. So quite a far cry from what I underwrote it to be. Does anyone want to hazard a guess as to why certain properties will be marketed well above what you would expect from a land basis value? What other things could contribute to additional costs or value, I should say? I'll give a hint. They bought it recently in 2020 for $6.1 million with no CapEx spend. They're evaluating at $12 million right now.
Neighboring developments.
That's a good guess. I like that. An economic force driving up the cost.
Yeah, I think maybe the land is expensive.
True, but they bought it for $6.1 million. And while land costs have gone up, not quite 100% in that 2-year time frame or 3-year time frame. Think about permitted uses, entitlements, anything like that. So in this case, being in Northern California, the person that bought this property did so as an investment, and they spent the last 3 years gaining the privilege to farm cannabis out of it. And because of that, because they've gone through a multi-year process to get the licensing, get that established with the property, which stays with the property. So in this particular municipality, you cannot transfer that license from one property to the next. When it is assigned, almost like a liquor license, it's staying there. Actually, that's not true. Liquor licenses can be transferred. But in this case, that's what they're basing that extra $6 million on, is like, hey, we've gone out and done all the work, put in all the hours, everything needed to get this ready to go. However, it's still not sold. So there's no one coming in looking to use it for cannabis, which puts us at a conundrum, right? We want to use it for a totally different use. Those permits have no use to us. So when approaching the broker and the seller, we need to have a pretty strong case as to why we're willing to pay what we're willing to pay and offset what they perceive the value as. So I did some research on what does it cost to get these licenses? And it's in the tens of thousands, not even the hundreds of thousands of dollars. The majority of that value is really predicated upon the amount of time it takes, the difficulty, and just the effort they put behind it. So we're preparing to submit an LOI on this property. And when I reach out to the broker and then eventually have discussions with the seller, I'm going to have them understand like, hey, look, you bought it at 6.1. We understand you want to see a return on your investment. We know that you had to put perhaps $40,000 into gaining these permits. So we want to offset that in addition to maybe the time value. So, having them understand, we know what it costs for you to do this. You're not losing out on money, you're losing out on time opportunity, but here's what we can evaluate it at. And ideally that this seller is motivated after sitting on it for 3 years to comply with that and move forward. It may not always be the case, but that's how we're going to take the approach and try to make this deal successful. Taking a look at the aerial shot here, guys, you can see this building. And once again, former Kmart. It might not look like it, but that's what it was originally used as. Does anyone know what is sitting adjacent to this property? Drive-up units. And off to the right-hand side, we can see vehicle storage. Which, as soon as I saw that, I got excited. I said, great, we don't have to fight to get this approved for rezoning. It's already adjacent to another facility with outdoor storage and outdoor vehicle storage. So that made it even more enticing because we would have less of an uphill battle from the rezoning standpoint. Taking a look at the front of the building here, you can see very large parking lot. It's sitting on over 12 acres. The condition of the asset in the building is still in a great place. It's sitting on a very busy freeway, Highway 160, which is what we want to see for these self-storage facilities. That way we get a lot of traffic, a lot of visibility. And just the exterior, obviously the pylon right here for marketing purposes is going to be great. The exterior facade looks like it's in good condition. What we can see of the paving here is good. And then you can just see a landscape of the competitors. This is a 5-mile radius here. There's already one new building in the area just adjacent to the property. It might have been the one we had just looked at. A couple of them back in 2020 would be the yellow dots. And I've already begun reaching out to these competitors, not only to identify their storage needs, but actually the broker of this property reached out to me to let me know that he had already reached out to any kind of outdoor vehicle storage in the area and was claiming that they're 100% saturated. Obviously, he has an incentive on getting this property sold. So I'm going to verify that, but it was intriguing or exciting to hear that any kind of vehicle storage is also very saturated in that market. So taking a look at the rates for this property, like I said, when you see that higher median household income, it typically will correlate to higher rental rates. We can see an average of 182. So on all the properties that we've shown on these calls, this is by far the highest outside of that property in Miramar, Florida, that I think was sitting around 230 for a 10 by 10. That number there is going to carry a lot of the weight of the CapEx in addition to giving us a higher value on the purchase price of the property. We can see a 10 by 20 going for as high as 346. And again, just any kind of seasonal fluctuations. What I like about the average 182 is it's not too far off of, most of the months on here. So it's showing smaller fluctuations outside of those last 2 months or last month of last year and first month of this year. So I'll pause there, going back to the summary slide and open up for any kind of questions from the group as we close out today's call.
So what did you have for a value on it as it sits for you guys?
I got it to pencil at 4.25 with 27% IRR. So that 30 is going to be a gold standard. We'll take opportunities in the high 20s, especially when the refi capital and the multipliers are very high. What I will need to do now, reviewing the underwriting, is like, okay, we've used 25% of the parking lot for vehicle storage. What if we push that to 40%? What additional cash flow can we expect? Is there a pad site that we could sell off? Is there any additional income, revenue, anything we can realize to help bolster that? Unless we're able to get this, maybe to $7 million on an asking price, I don't think the seller is going to come down. They definitely won't take a loss, and they're not likely to take a marginal gain for the period of time they've been holding it. Other questions?
Was there some additional land next to this building? It looked like when in that rendering or that drawing with the parking lots. Right to the whatever that would be the.
There's some
east.
land right here. This would be a separate parcel. Everything that we're looking at would be in this vicinity here.
Okay,
So-
but that patch of land next to the building there, that's not.
That is not shown to be included with it. I think we're looking at these two sites right here.
Yeah.
But that is something to inquire about if it's owned by the same person or if that's something we can scoop up. There's times where we've reached out about a property and actually the city has said, hey, we own the 5 acres adjacent to it. We're willing to roll this in, or maybe talking with the broker and the seller is like, hey, what about these spots here? Can we do some outdoor storage as well, or additional vehicle storage, depending. In this case, because of the saturation of self-storage, we would probably look towards more utilization of vehicle storage. Great question.
How warm is the seller to taking a loss on the sale of this asset?
Not determined at this time. I've only spoken with the broker, but he is highly motivated about selling this property. He was brought in 2 months ago to replace the previous broker that had fumbled this deal and just left it on the market for this long. But I think getting the initial LOI out to the seller can get the conversation going, and we can really probe and see what their selling temperature is.
Yeah, because besides a cannabis operator, there's nobody else in the industry that's going to be paying 12 million for this asset. So, and of course, it's still federally illegal, that being cannabis, that becomes it being more limited as far as lending opportunities. So I think the $3.3 million offer that we're going to support is going to be more than fair based upon the asset, its condition, but I really do love the location.
Agreed. We'll get this fired up and sent out by tomorrow. So we had to take a look at 2 different properties. Oh, someone have a question or objection? So yeah, just to summarize today, guys, we had to look at 2 cool properties, one in Racine, Wisconsin. That was a great example of talking with the city, the EDC, to help move the needle along on these projects. And then just a great example of what vehicle storage, enclosed self-storage in an ideal market would look like. Antioch is something that I'm continuing to scout new opportunities on and off market. The broker Delvin that is representing this property is sending me other leads daily to kind of review. And when you find an area like that, it's a great place to saturate because you have already knowledge of the city, their ordinances, rezoning process, rapport with them. So if you can find an area to be a subject matter expert of, you're going to be able to expedite the deal flow because you're already in transition with it and doing more properties out there. Well, thank you for your time today, guys, and joining today's call. We look forward to seeing you all next week. Again, my email is in the chat. If you shoot me a note, I will share the unit mix calculator, and always open for questions. Follow up if you guys want to submit your leads. We also review those and would partner with you on moving forward.
Thanks, Nick. Great job. And just to put that out there again, we are looking to expand our team to incorporate office to multifamily. So if you're interested in joining our team and looking and scouting out for opportunities there where we can convert a large amount of office space to multifamily in some ideal markets, reach out, let us know. Anyways, thank you everyone for joining. Have a great day. God bless, and we'll see you all next week.
Thanks, guys.
Thank you. Thank you, guys.
Have a good day.
Great stuff.